Welcome to the Deep Dive, your essential shortcut to being well-informed. Today we're tearing into the General Dynamics second quarter 2025 earnings conference call. Our mission, to really distill the most important insights from what leadership said and the latest financials. We want you to quickly grasp how this major defense and aerospace player is performing, but also how they're investing and transforming for what's next. No fluff, just the critical details.
Exactly. We've gone through the call pretty meticulously, looking for those pivotal data points and the signals from management that really tell the story of where General Dynamics stands and, maybe more importantly, where it's headed, looking beyond just the headlines.
Okay, so let's jump right in then. A snapshot of the results first. General Dynamics had a genuinely robust second quarter. They delivered an impressive beat on Wall Street's EPS consensus by 19 cents, which is pretty notable. For you, the experienced investor listening, that's not just a beat. It kind of signals a fundamental strength in their underlying operations, right? Exceeding expectations even in this dynamic market.
It really does. And the numbers, they definitely underscore that strength. Total revenue hit $13 billion. That's an 8.9% increase over the year-ago quarter. And operating earnings climbed nearly 13% to $1.3 billion, which, demonstrates some significant operating leverage. Profits growing faster than sales.
Right. Leverage is key. And that strong operational performance, it flowed right to the bottom line, didn't it? Net income just over $1 billion, up 12% year over year. And diluted EPS at $3.74. That's a solid 14.7% increase from the prior year. If we zoom out a bit to the first half of 2025, the picture stays incredibly strong. Revenue up 11.3% to $25.3 billion. Operating earnings soaring 17.4% and diluted EPS climbing 20.5% to $12.60.
Yeah, and what's particularly striking here, I think, is management's own assessment. They described the quarter as wonderful, said it exceeded expectations, and led to a very good first half. Now for investors, that's probably not just boilerplate confidence. It feels like a rare and strong signal that management sees real, tangible drivers behind this performance, not just, one-off wins.
That kind of confidence from leadership is definitely compelling. So given that, let's dig into the pivotal financials underpinning this performance. When you think about the future health of a company like GD, where do you see the most important indicator? What should we look at first?
Absolutely. For a defense and aerospace giant like this, it almost always starts with orders and backlog. And Q2 was, they called it a huge quarter for orders, totaling over $28 billion. That gives you an impressive company-wide book-to-bill ratio of 2.2 to 1.
2.2, wow. So booking more than twice the business they actually delivered in the quarter.
Exactly. That's a powerful forward-looking indicator for future revenue stability. Marine Systems was the biggest driver here. They secured multiple big contracts for critical submarine construction.
But the strength wasn't just confined to Marine, was it? Aerospace also had a tremendous quarter, hit a 1.3 times book-to-bill. Management highlighted this as their strongest first half for orders since 2022. That signals pretty robust demand for Gulfstream jets.
Mm-hmm. And all this activity pushed the company's backlog to a record level, $103.7 billion. That's up 14% from a year ago.
$103 billion, okay.
Mm-hmm.
And if you include the options and those IDIQ contracts,
mm-hmm.
the indefinite delivery, indefinite quantity ones.
Right, the ones that give the government flexibility.
Yeah, the total estimated contract value reached an all-time high, over $160 billion.
That record backlog, over $160 billion, it really does de-risk their future revenue streams significantly. It provides, tremendous visibility and stability, especially in defense, where these contracts are so long-term. Allows for better planning, better resource allocation over, multi-year cycles.
But a fantastic pipeline, no doubt. But as we know, backlog alone doesn't always guarantee a healthy business day to day. The real question then becomes, how effectively are they converting that pipeline into actual cash? Let's maybe turn our focus to cash generation. Strong orders are great, but you need the cash flow to back it up.
And they certainly delivered there too. General Dynamics generated $1.6 billion in operating cash flow this quarter. After capital expenditures, their free cash flow stood at a really impressive $1.44 billion. That gives you a strong cash conversion rate of 138%.
138%. That's converting more than their net income into free cash for the quarter.
Precisely. And year to date, their free cash flow is $1.1 billion, which management explicitly said is well ahead of what was planned.
Okay, so they're tracking ahead and looking forward.
They anticipate a strong second half. Most of that cash generation is expected in Q4, which is pretty typical for them. This should push them towards a full-year cash conversion rate around 90%. That's actually an improvement from their original forecasts.
And that doesn't even include the potential upside from that recent tax law change, right? The R&D capitalization reversal.
Correct. That full-year cash estimate doesn't yet factor in the positive impact from being able to deduct R&D expenses immediately again. So potentially some upside there too.
Okay. This strong cash position, it naturally leads us to think about capital deployment. What are they doing with the cash?
Right. So in Q2, capital expenditures were $198 million, about 1.5% of sales. They expect this to tick up in the second half, though, projecting over 2% for the full year. So continued strategic investment in their operations. They paid out $42 million in dividends, but interestingly, made no share repurchases in the quarter, which they said was largely due to their cash profile and timing.
And on the debt side,
They proactively refinanced $750 million in notes that matured back in May. Now they have no further debt maturities until next year, which gives them some breathing room. They ended Q2 with a healthy $1.5 billion in cash on hand. Net debt position was $7.2 billion, which is actually down $1.2 billion sequentially, so paying down some debt.
okay. And interest expense.
Net interest expense for the first half was up a bit, mainly due to using commercial paper. They estimate it will be approximately $330 million for the full year. Seems like a very disciplined approach overall to capital management.
It does. Robust financial health. Strong cash allows them to manage debt, invest for the future. Seems solid.
Yeah, definitely a strong foundation.
So with those strong financials in mind, what does this all mean for the individual segments? Let's turn our attention now to management's insights on each of their key business areas, maybe starting with Aerospace, Gulfstream, and jet aviation.
Sure. Aerospace had really a standout quarter. Revenue was up 4.1% to $3.06 billion. But operating earnings jumped an impressive 26.3% to $403 million.
Wow, that's significant leverage there too.
Exactly. Resulted in a big operating margin improvement, 230 basis points. They delivered 38 Gulfstream aircraft in total. That included 15 of the new G700s, which is 4 more than the year-ago quarter. They also completed the final deliveries of the older G650 model.
And what about the supply chain? We always hear about that in aerospace.
Yeah, it continues to improve, according to management, both in schedule and in quality. That's obviously crucial for getting a predictable delivery cadence, especially for the new G700. They also highlighted that all those G700 retrofit and pre-engine installation aircraft, the ones that were kind of dragging on costs before, have now been delivered, so that hurdle is cleared.
Okay, good progress. But then they mentioned the G800 deliveries starting soon.
Yeah.
And something about margins.
Right. Initial G800 deliveries are set to begin in Q3. They expect about 13 for the year. However, management cautioned that these initial G800s, along with some G700 flight test aircraft they're delivering, will initially be lower margin. So they'll likely be dilutive to the overall aerospace operating margin in the second half of the year.
So what should an investor make of that short-term margin pressure then? Is it a concern?
It's pretty much a classic ramp-up dynamic for new, highly anticipated products like these. While there's some near-term pressure, management is looking further out. They anticipate high-teen margins, think above 15% potentially by 2026, and they said certainly by 2027. Now, they did flag an expected temporary dip again in 2028 when significant deliveries of the G400 begin, because that's just inherently a lower margin aircraft.
Okay, it's about the mix.
Exactly. The mix of aircraft is key. G700 has the highest margins. G800 expected to be similar long-term than G600 and so on. That mix heavily influences the quarterly results. So you have to kind of look through the initial investment phase to the longer-term payoff potential.
Right, and that's before even factoring in the services business, which is huge, $3.5 billion in sales, and affected by all sorts of things like warranty work, part sales, MRO mix, FBO volume. It's complex.
Very complex. But despite all that complexity, the underlying demand seems really strong. They use the phrase very strong market demand across all models, G700 and G600 leading, but the G800 is generating particular interest, and that's across the US, Europe, and the Middle East. That 1.3 book-to-bill was achieved even with increased deliveries, which is a powerful signal of market strength.
Okay. Strong story in aerospace, despite some near-term margin noise. What about marine systems? You said that was a big driver of orders.
Yeah, Marine is really a significant growth engine right now for General Dynamics. Revenue surged 22.2% year over year. That's huge growth, hit $4.22 billion. Operating earnings were also up strongly, 18.8% to $291 million. Now, their operating margin currently stands at 6.9%, and management was quite open about this, acknowledging plenty room for improvement there.
6.9% margin on that much revenue. Yeah, you can see the potential if they improve that. What's driving the growth?
Yeah.
It's primarily the big submarine programs, Columbia and Virginia class submarine construction. Also, a slight increase in the DDG-51 destroyer work. And the backlog for Marine just exploded this quarter, increased by $14.6 billion. That's up 38%, bringing it to almost $53 billion.
$53 billion just in Marine backlog.
Just in Marine. A large part of that jump came from a contract for 2 Block 5 Virginia-class ships, including one that's a unique special mission variant. Plus, importantly, the contract included significant investment funds earmarked for shipyard productivity improvements, wage increases, and training programs.
So funding specifically aimed at tackling those industrial-based challenges we hear about.
Exactly. Funds designed to help stabilize and ultimately improve the submarine industrial base, which benefits everyone involved. But management did acknowledge they are still experiencing supply chain delays and quality problems. Things like late materials, late parts, quality escapes, impacting workflow.
That issue of supply chain delays seems persistent across the defense sector. What does it really mean for their submarine timelines? Are they managing it?
Well, they said they're developing good workarounds, and they emphasize close collaboration with the Navy and the new administration to address these issues, improve throughput, and boost performance. It's clearly a critical area of focus for them. Getting those programs humming is vital.
Okay, a growth story with acknowledged challenges they're working on. Let's shift to combat systems. How did that segment perform?
Combat systems showed, I'd say, really solid operating discipline. Revenue was relatively flat year over year, came in at $2.28 billion. But, and this is the key part, operating earnings actually increased by 3.5% to $324 million.
So earnings up on flat revenue, that's that operating leverage again.
Precisely. Their operating margin expanded by 50 basis points to 14.2%, doing more with essentially the same revenue base. Strong execution there. The growth driver, interestingly, was Europe. They had a 1.5x book-to-bill in Europe in the first half.
Reflecting the increased defense spending over there.
Seems like it. Significant potential as European defense spending continues to accelerate. That strength in Europe offset lower volume they saw in the U.S. combat vehicle business, partly due to the cancellation of the Army's Booker program. Management also highlighted strategic investments they're making, kind of ahead of need, to support future priorities like the rapid development of the next-generation main battle tank.
Munitions, that's part of combat systems too, right? Big focus globally now.
Absolutely. There's a clear focus there on expanding facilities and significantly increasing production rates for artillery-related products. We're talking projectiles, load assembly, pack, propellant, all the key components, definitely aligning with broader global defense needs right now.
Okay, makes sense.
Yeah.
Finally, let's look at the technologies group. That's GDIT and mission systems combined.
Right. For the technologies group overall, revenue was up 5.5% year over year to $3.5 billion. Earnings were up 3.8% to $332 million. The operating margin for the group was 9.6%. That was actually down slightly, but it was due to a mix shift. GDIT, which generally has lower margins than mission systems, grew faster in the quarter.
Okay, understandable mix effect. How were orders?
Order activity was solid. Book-to-bill just under 1.0x for the quarter and just over 1.0x for the first 6 months combined. Their backlog is up 7.5% year over year, and the total estimated contract value is up 11%. So healthy pipeline growth there, too.
And breaking it down between GDIT and mission systems.
GDIT delivered a solid quarter, growth across all its customer-facing divisions. Management said they navigated contract scope changes and some cancellations effectively. Despite what they called significantly lower first-half customer adjudications, basically, slower contract award decisions by the government, GDIT still managed to secure 6 big wins over $100 million, including one massive one over $1 billion. They feel their investments in digital accelerators, things like AI, cyber, mission software, and their strategic tech partnerships are paying off.
And mission systems.
Mission systems saw revenue, earnings, and margins increase across all comparators. So strong performance there. Management described this segment as being in its final year of transition, moving away from some legacy lower margin programs towards new higher margin franchises. They feel an inflection to growth is now being observed, so potentially better performance ahead. To combat, they're also investing ahead of need in key areas. Unmanned platforms, smart munitions, high-speed encryption, strategic deterrence, contested space, the hot areas in modern defense tech.
Okay. One thing to note, though.
Yeah, they did point out that some of the first half strength and mission systems came from their high-speed encryption product business. That part of the business tends to be more transactional, less predictable quarter to quarter, so it adds maybe a layer of potential volatility there.
Got it. Okay, so we've covered the segments, all these operational details that lead us to the broader management insights, and importantly, their revised guidance for the year. What struck you as maybe a key strategic takeaway from the management commentary this quarter, beyond the segment performance?
Well, one thing that really stood out, and it might seem like just a personnel announcement, but I think it's more significant, was the appointment of a new executive vice president for global operations, Danny Dape. This isn't just filling a role. It signals, I think, a reinforced company-wide focus on optimizing operating leverage across all the business units.
So really doubling down on efficiency and execution across the board.
Exactly. The emphasis will be on driving continuous improvement across the entire value chain. Everything from contract discipline, supply chain efficiency, manufacturing processes. And they specifically mentioned giving particular attention to challenging programs to improve their performance and get them up the learning curve, as they put it. It really underscores their long-standing commitment to operational excellence, but maybe with a renewed intensity, especially targeting areas like marine.
Okay, that's an interesting strategic signal.
Yeah.
So how does all this translate into the revised 2025 operating forecast? What are the new numbers?
Right. So for aerospace, revenue is now expected around $12.9 billion. That's up $250 million from their prior estimate. Gulfstream deliveries also revised up slightly to a range of 155 aircraft for the year. The operating margin forecast, however, is reduced slightly to 13.5%, down about 20 basis points, mainly due to that mix effect we discussed and some dynamics in the services business.
Okay. And combat systems?
For combat, revenue now projected around $9.2 billion. Operating margin held steady in the guidance at 14.5%. This combination should lead to somewhat improved earnings compared to what they previously expected.
And marine systems, the big growth story with the margin focus.
Yeah, for marine, revenue now anticipated around $15.6 billion. Still showing strong growth, although maybe at a slightly lower rate than implied before. The operating margin guide is 7%. But importantly, this level is expected to provide better earnings than they previously estimated, likely due to the higher revenue base.
Got it. And technologies?
No change there. Technology's revenue and earnings estimates remain unchanged from the initial 2025 forecast they gave earlier in the year.
Okay, so pulling it all together company-wide.
Company-wide, General Dynamics now expects revenue to be approximately $51.2 billion. That's an increase of $900 million from the prior guidance. The overall company operating margin is being held constant in the forecast at 10.3%. And all of this rolls up to an increased EPS forecast. The new range is $15.05 to $15.15 per share.
So raising the full-year outlook on both the top and bottom lines.
Correct. And management expressed pretty strong confidence looking into the second half, building on what they called that very strong first half.
Okay, let's try to connect all these dots then for you, the listener. General Dynamics delivered a very strong quarter. Significant beats on earnings, robust revenue growth pretty much across the board, and exceptional order activity driving those record backlogs.
Yeah, and their cash generation is running ahead of schedule. Full-year guidance raised. It paints a picture of a company executing well and feeling optimistic about the path forward.
So from an investor's perspective, what are the key areas to really focus on going forward? In aerospace, it seems like the successful ramp-up of the new Gulfstream models, the G700 and G800, is a major catalyst. You have that expected initial margin dilution, yes, but the long-term outlook for high-teen margins, driven by mix and volume, looks incredibly compelling, and that underlying global demand seems very strong.
It's a powerful tailwind. Definitely. Then you have marine systems, clearly the big growth engine with that massive backlog, but its operating margin, that 6.9%, is absolutely the key area for improvement. It's a critical focus for management now. The attention on supply chain stabilization, shipyard productivity, significantly boosted by that Navy funding and investment, is essential if they're going to realize the full potential there. Management's direct focus, and now this new EVP role, on getting challenge programs up the learning curve. That's a very positive signal for potential future margin expansion.
Right. And the other defense segments, combat and technologies, they continue to show strong operating discipline. Combat systems expanding margins, even with flatter revenue, is impressive. Strategic investments in next-gen capabilities, plus that accelerating European demand for combat, are encouraging signs. Technologies navigating a fluid market, especially with government contract award timing. That pace will be key for the second half, particularly for GDIT. And mission systems hitting that transition inflection point could really start boosting profitability there.
And overall, that appointment of Danny Deep as the new EVP for global operations, it just reinforces that company-wide push for operational excellence. Unlocking further operating leverage, especially in Marine where there's, significant room to run on margins, it feels like a serious commitment.
All right, let's put on our hedge fund pod analyst hats for just a moment here. And remember, folks, this is absolutely not financial advice. This is purely a thought experiment based on the earnings call details. Given General Dynamics' strong Q2, and this explicit management focus on operational improvement, particularly in marine systems, here's an outrageous but plausible trade idea we cooked up.
Okay, we're calling it the Marine Margin Multiplier Play. The idea is you go long, General Dynamics, ticker GD, but with a very specific thesis. The thesis is that this new EVP for global operations, Danny Deep, is going to dramatically accelerate margin expansion, specifically in the Marine Systems Group over the next, say, 18 to 24 months.
Now, the outrageous part of this is betting on the speed and the magnitude of that improvement, pushing those marine margins significantly higher than the current 6.9%, maybe even towards the high single digits, or dare we say low double digits eventually. Given the sheer size of marine systems and that enormous backlog, that kind of margin expansion would be a massive unlock for the overall company valuation.
Right. And the plausible part, management explicitly highlighted marine margins as the key area for improvement. They acknowledged the room for improvement. They committed to driving programs up the learning curve. They just appointed someone specifically tasked with optimizing operations globally. So if they actually succeed, if this new EVP can really get those shipyard operations humming and drive efficiency, the market could potentially re-rate GD's defense segments, providing a significant upside catalyst beyond just typical defense multiples. It's really a bet on operational execution delivering outsized returns.
An interesting thought experiment. Anyway, so to recap the whole quarter, General Dynamics delivered a powerful second quarter. Broad-based revenue growth, impressive earnings beats, record backlog levels, pretty much firing on most cylinders.
Yeah, and while they're navigating the complexities, especially around new aircraft deliveries in aerospace and those supply chain challenges in marine, management's strategic focus seems clear. Operational leverage, continued investment in next-gen capabilities. It positions the company well.
We encourage you, as always, to consider how these insights shape your own understanding of the defense and aerospace landscape. What stands out to you as maybe the single most impactful takeaway from this deep dive into General Dynamics? Something to think about. And as always, please remember, the information discussed today is strictly for informational purposes only. It is not financial advice.
Thank you for joining us on the deep dive. We look forward to our next deep dive with you.